Today we're going to be talking about liquid staking participation and also the launch of Liquid Collective, a new enterprise-grade liquid staking protocol that's supported by many partners on this panel and then other partners in the room as well. My name is Schmiedt. I'm the Chief Growth Officer at Alluvial. Alluvial is one of the software development companies supporting the development of Liquid Collective.
Sure. Hi, everyone. I'm Ernest Oppetit. I'm co-founder and chief product officer of Kiln. So this is our office, part of our. We are a technology provider of Liquid Collective. We've been developing the protocol, and we're also an enterprise-grade staking platform. Matt?
Matt Leisinger. I'm the CEO and one of the co-founders of Alluvial. So we're, as Mara said, supporting the development of an enterprise-grade liquid staking standard.
My name is Yves Holenstein. I'm head custody and staking at Bitcoin Suisse. We're one of the oldest crypto financial service providers in Europe, and happy to be part of this Liquid Collective undertaking.
Freddie Allen. I'm at Coinbase Prime, Coinbase Institutional. I'm the staking specialist. Coinbase Prime is a holistic prime broker platform, custody, OTC desk, linked to the exchange. We support staking as well, and we're a founding partner of Liquid Collective and an integration partner, and we also a validator operator.
Awesome, great stuff. So maybe just to get things started and kind of set the foundation, let's talk a little bit about liquid staking. So maybe Matt, you can touch on that a little bit. What is liquid staking for, and how does Liquid Collective, build a solution for the market that is needed today?
Yeah, absolutely. So with staking, you're able to stake your assets and participate in the security of the network. But there's this lockup of tokens. So while you earn a reward, and that's great, generally you're giving up liquidity to do so. And so what liquid staking does is it improves on that, where you stake your tokens, you get a receipt token, where you're able to utilize that token, still earn rewards, and maintain your liquidity. And I think one of the things that we found, as I worked at Figment previously, we found that liquidity was really important to customers, but some of the solutions weren't necessarily adequate. And so while liquid staking changes the verbs of stake and unstake to buy and sell, which is an amazing paradigm shift for end users, what existed in the market from a compliance and security perspective really just didn't hit the bar for a lot of institutions that required a bit more. And so we set out to really improve upon that with our enterprise-grade offering.
Awesome, that's great. And Ernest, you mentioned this earlier, but Kiln actually started supporting the development of this project really early on. So what drew your team to
it was a phone call from Matt initially. It was almost a year and a half ago, I think. You were at Figment, you led the product conception, right? Understanding the use case, the demand from the market. And we partnered on this, Kiln bringing mostly our engineering team to help develop this protocol. And we were totally aligned with what you identified as requirements that were not being satisfied in the liquid staking market around compliance, institutional grade, validator set, these kinds of things, and also a channel partnership model, right, with integrators. So we were sold and started working together. Yep.
Awesome. And Freddie, you have a little bit of a different perspective coming over from Coinbase, looking after some of the institutional clients. How does this institutional market feel about those innovations in staking?
It's there's an extraordinary amount of demand and interest for liquid staking products, particularly LsETH's and Liquid Collective, primarily for three reasons. It's secure, so the underlying validator operators are well diligenced and partnered with Liquid Collective. It's compliant. There's KYC, AML at the integration gates. A lot of institutions just can't participate in crypto without KYC, AML. And Liquid Collective is also tax efficient and cost effective as well with its C token model. So a lot of interest.
Awesome. And you guys have obviously been in the market for a while and institutionalizing a lot of crypto native offerings. How does liquid staking fit into your product strategy?
Well, we're in a regulated market. We're not directly regulated by FINMA, but part of a self-regulatory organization and have to fulfill the same KYC, AML requirements. And most of DeFi is just out of reach for us for AML reasons. We just don't know the counterparties. And so there has been a lot of demand from our client base. We have like 2 types of clients with those crypto natives, high net worth individuals or whales, and institutionals. And they have different reasons why they want liquidity. Crypto natives, they really just want to participate in DeFi, or they want to avoid market risk, naturally, which isn't that big of an issue with Ethereum, but with other protocols it may very well be. And the institutionals may have other reasons. For example, when you're creating a bankable product like an ETP, you have to have daily redeemability, which you can't do with staked Ethereum if it's locked up forever until Shanghai or even after Shanghai. So there has been a lot of demand but no solution. And now finally we have not only a cool solution, but with the players involved, also a really big chance that this will be very successful and have the respective traction.
It's awesome. I really like you touching on sort of the use cases that you think might emerge in the structured product market, for example. Are there any other sort of customer segments or innovations that you guys expect to be able to unlock with this type of product?
Yeah, I think so. We're seeing that already with a few structured products. So once you've put in this liquidity layer where you're mobilizing staked asset collateral, you're able to offer a number of different strategies or products that you can offer on top. So one thing we've seen is a market neutral strategy. We're able to hold LsETH, but utilize that as collateral to go short Ethereum and maintain, remove the price exposure. And so you're basically just getting the rewards rate straight. And so we're seeing structured products around that, not only on the DeFi side, but actually on the centralized side, because we're meeting folks where they custody their assets. And so, on the Coinbase side and Bitcoin Suisse side, we're hoping that you guys innovate as well and help builders that build out these products continue to innovate. But we're seeing a ton of traction there.
Big demand from the hedge funds for that exact trade. So Coinbase Prime is a financing desk, and we're hoping to support the use of LsETH as collateral to execute that sort of trade.
That's awesome. It's very collaborative and somewhat atypical, I think, in terms of how protocol development usually comes together in the ecosystem. So, Matt, can you talk a little bit more about how Alluvial fits into that picture, and maybe also what the difference is?
Yeah, absolutely. So, it gets a little. Let's go with. Alluvial is a development services company that supports the development of Liquid Collective, but Liquid Collective is supported by a number of different partners. On the integrator side, we've got Coinbase and Bitcoin Suisse, and obviously Kiln as a tech provider helped out with the Ethereum implementation. But it really doesn't stop there. We think that we can scale across to other chains. We're going to be a multi-chain standard, and with that, the way that we scale quickly and in the right way is by partnering with native builders. So for instance, we've announced a partnership with Akala to basically offer liquid staking on DOT. And the benefit of doing this is they already have a native chain implementation. And with that, it's already stood the test of time, already has some lendiness built into it, but they also have the relationships with that community already. And so what we offer is essentially a way to connect that to some of the integrators here today. And so we're looking to expand not only from Ethereum, but across other chains as well.
That's really great. I think we're at about, 15 companies in the collective now? So
That's right.
Builders and businesses and Oracle operators. It's pretty impressive how quickly things have come together between the 3-4 businesses in the beginning. That's
all in about a year or not even.
Yeah, it's quite amazing, and when you allow folks to focus in on what their core competency is in the stack, it's amazing what you can build together.
For sure. no, it's great. And it's been honestly incredible to see everyone sort of rally around that. Liquid Collective actually launched 2 weeks ago, so let's double click on that real quick. For those of you who are not familiar, I would love to hear just how did the launch go, and like we can sort of go around the table since we were all part of it.
Yeah, I mean, from our perspective, I think it went really well. Like the protocol is working well. It's in mainnet. Everything is being well monitored, and probably a round of applause to a lot of people in this room who worked on that. Yeah, just a huge effort across product delivery, communications. Everyone works together to ship something like that. So I think it went really well, and then there's some traction coming in from the integrator side, which is awesome to see as well. Yeah.
Yeah, and I'll just kind of plus one that. I think this is the first time that you've seen this many different partners kind of collaborate together on a protocol launch, combined with a day one listing and a number of other things that had to come together. So thank you to all the partners. Like, truly was a Herculean effort to get to this point. And really the execution was flawless. I think that we had no major issues. We spent a lot of time in beta and testing and making sure this was right, because again, you had a protocol that interfaced with integrators that didn't develop the protocol, and so a lot of handoffs, and as Ernest said, a lot of coordination. So it's amazing to see what we've been able to build in the last year. But yeah, as far as traction, I'll let you guys speak to that.
Well, I'll chime into that, but maybe first, more like the technical side. I also have to say a big thank you. We had absolutely flawless technical start of everything, so there's not a single hiccup. That's really great. But then also on the traction side, we had some clients that immediately wanted to go in with some pretty large sums. So that also showed the confidence both in us, but also in the protocol, the team behind the protocol, and the collective. And that was really cool. What we will only start this week really with the sales campaign, because we wanted to give it first a few days to see how everything works, and we expect some big traction when we go out this week. But we already see certain questions coming in, and it's funny because I had to nod so many times before when Joaquin was saying certain things about DeFi protocols and liquid staking. Like, some of the questions are, so what exactly are the additional risks? What's with the contract behind it? What can happen? Who can I sue? Who is my counterparty? Because we're not really the ones that provide the staking. We're just providing the service of access to the protocol. So a lot of those non-technical topics that we assemble a lot of those questions and trying to educate the clients.
So huge credit to the Liquid Collective and Alluvial team in the launch. The marketing material and the communication with us as integration partners, but also publicly, was absolutely incredible. On the Coinbase Prime institutional side, what we're seeing now is the institutions really need two things that they work through. The first is internal education and due diligence, and a lot of times, a lot of clients, the traditional non-crypto native, that takes a long time, and that's understandable. So it's not like a day one sort of, LsETH's launched, let's go, you're going to see the huge TVL and traction. So there's those internal factors which we help with, and everybody helps their own clients with. The second piece is the usability. It's like, okay, what do we use it for? What's the risk-return trade-off that's really going to push them over the edge to pull the trigger and mint, start using? And those sorts of usability will increase as dApps are more dApps are integrated. You have more centralized financing desks like us who can accept it as collateral, and you can execute these trades that we touched on before. So that again will happen with time.
And maybe when you can withdraw your ETH.
Yeah, exactly.
Yeah, we're getting into it, which I really don't want to double click on. So there's been a lot going on in the ecosystem. The Ethereum core development team is making major leaps towards the Shanghai fork, which we'll talk about in a second. We're seeing a lot of stuff happening on the regulatory side. Let's talk a little bit about sort of trends that can be accelerants, but also potential blockers to the adoption that we're seeing. And Freddie, you touched on a couple of those. So maybe Matt, what are your thoughts on that?
Yeah, definitely. I think, there's been no lack of news over the past month or so. And so, with that, I think you've seen from the regulatory perspective some news that's come down. And so we've actually, we kind of took the news in and looked at it, and it kind of validated what we were building in that, we're a non-custodial liquid staking solution, and we offer a number of benefits. We built this with the regulatory landscape in mind, and so we look to really just offer we have a design principle that we offer the features of Ethereum, but with liquid staking layered on. And so with that, I think we've made no changes to the product, so it's really validated that design. I'll also say that we've done a ton of work with POSA and the liquid staking white papers that have come out recently, and so we're really excited about that. I think that on the regulatory front, we're positioned really well as opposed to actively managed staking solutions.
Yeah, and Alluvial was part of the working group with POSA, so would love to double click on just some of the content that was released as part of that initiative.
That's right. So the work we did there essentially outlines how we should view liquid staking tokens. So liquid staking tokens allow you to obviously stake, and you get a receipt token, but this receipt token actually proves your beneficial ownership of the staked asset. So this has a nice design piece to it where in the LsETH user agreement, which is connected to the token, we actually make that claim. So in the white papers, they talk a little bit about essentially the regulatory guidance there, where this is just like a digital warehouse receipt, just like in commodity markets where you might take delivery of a commodity and get a receipt. That receipt gives you beneficial rights on that commodity. In the same way, digital warehouse receipts give you, liquid staking tokens give you a receipt on your digital assets.
Awesome. And probably in sort of the same context, Coinbase is, of course, very, very active in a lot of this U.S. policy discourse. I'm a big retweeter of Paul's content that's coming out. How does Coinbase sort of see the continued conversation with policymakers in the space as it relates to staking in particular?
Very topical, and it's great that you mentioned Paul's our head of legal, Coinbase head of legal, is very active publicly on his Twitter account, but also on our website with blog posts. So in answer to your questions, I see it as really two things. It's being proactive. We have a huge legal team, huge policy team that spend a lot of time, particularly more recently over the past 6 months, on Capitol Hill, constantly engaging with the regulators, maintaining those lines of communication. Brian Armstrong, him wearing a suit is incredible, and he's been wearing a suit a lot recently on CNBC and down in Capitol Hill. So there's those activities in conjunction also with different industry groups like Proof of Stake Alliance, and working with other huge funds, huge names like Andreessen, being super proactive. The second piece, I think, is Coinbase's own brand of being around for 10 years now, being listed, leaning into regulation is something a little catch cry we have internally. So those sorts of that sort of brand awareness, and Brian Armstrong in particular, and the entire executive group at Coinbase really hold true the entire crypto thesis of decentralization, and are willing to, and they publicly say they're willing to really die on the hill, Capitol Hill, if you will. So, and you just follow either Paul's or Brian Armstrong's own Twitter account, you really see him happy to continue to hold that he'll happily go to court with the SEC over whether it's an interest-bearing account or decentralization of staking and things like that.
And it doesn't end in the US. I mean, whatever you guys are doing, what POSA is doing, etc., also helps us and everybody else who's to deal with regulators, because we all have to. I mean, they're maybe less hostile than they are in the US, but we have to help them educate themselves. And all that work that POSA is doing is really, really great. And just to add on to Liquid Collective here. When we got into the game quite late, we were last fall, we had the first contact points with you. And the one thing I remember, a phone call with Michael, who was driving it in our team, when I was in a car, and we just really discussed about the fact that you started from the regulatory side, more or less, how to design the product that it actually can survive and can be compliant. And that's the one thing that really convinced us that, like, okay, they're taking it serious. It's not just some technical way of doing it, but has the right mindset. Yeah.
Awesome. Love to hear it. Awesome. Let's kind of dial back a little bit to something that is, currently happening in the ecosystem with the upcoming Shanghai upgrade. So the enablement of withdrawals on Ethereum, which, if anyone else is staking in this room, obviously much anticipated, since Ethereum hasn't been withdrawable for participants who have staked. Obviously, this is going to be a major development milestone in many ways, also an important financial and technological consideration and current risk factor that customers, users, and institutions, think about. So would love to hear a little bit more, from you guys about how you think this will impact actually demand and adoption in the market. And maybe, Freddie, we'll start with you and sort of go through the rounds.
Yeah, absolutely. Basically, very briefly, there's a huge amount of Ethereum sitting on the sidelines that's not staking. That's obvious in the staking rate or staking ratio of Ethereum. I think it's about 14, maybe crept over 14%, which is well below the industry average of 60, 70% staking rate. So there's a lot sitting on the sidelines for a couple of reasons. One is particularly the traditional non-crypto native. A lot of the funds or ETP providers, they physically can't stake until Shanghai because they physically can't have, it's not in their investment mandate to have something locked up with an undefined time period, so they just can't do it. It's similar to liquid staking products now. Before Shanghai, it's kind of the same. Even though the token is liquid, if you want to redeem the underlying, you still can't, so they physically can't get into it. So there is that waiting game at the moment.
Yeah, exactly the same with a lot of our clients. When they're regulated, or pension funds or anything like that, it's just a no-go to have this one-way street. And I really expect there's a lot of ETH being freed up to go into staking. Probably midterm. I don't expect that to happen in April, but over the 6, 7, 8 months following. However, on the short term, I expect a lot of those locked rewards being restaked, which is great. So that's again, that's probably more on the crypto native side. They want to get those additional gains and stake it. But then there may be, I believe, a rather small portion that just wants to get out of the staking now that they finally can. But so we will probably see some volatility in the staking volumes after April 12th. But in the midterm, I definitely see a lot more being staked.
I think it's a really good point, especially the volatility around that, because I think we're going to see the volatility not only in like the rate, but also you've got to understand that the activation and exit queues come into play here as well. And so with that, you're actually adding on not just like a static time to wait. You've got variability, which adds to the operational burden of managing the unbonding. And so a liquid staking token, just holding it gets you your rewards and you're able to exit your position immediately. And so while I think we'll see staking participation rate increase, we'll also see liquid staking participation rates increase because these funds, these funds don't want to manage that either. They'd rather exit their position immediately. And so with the volatility, you actually see a lot of volatility actually in the exit and entry rates as well. And PSA, stake now, because we don't know what this is going to look like, after withdrawals.
Yeah, I think if there's an increase of 10% in the number of validators, so there's about 550,000 right now. If there's another 50,000, that would take about 45 days to process. Yeah. So it's a long entry queue that will get created. So yeah, get in while you can is spot on. And yeah, just to add, at the protocol level, we're getting ready for redemptions, right? It's code complete, going through audit, testing on Go already. So that's very exciting. Obviously, the protocol, the token is already liquid. You can through exchanges and Uniswap, but this is going to be the redemption in kind at a deterministic rate based on the rewards that have accrued on each user's position.
Maybe one thing that probably only applies to us here in this round with Shanghai is we historically had staking sizes that were even below 1 ETH that we allowed. But with the regulation we're in, whenever there's more than one client sharing a validator, we have to consider this collective custody, which means we have to cover this with a bank guarantee, which we have to back with equity, so it's extremely expensive for us. And now Shanghai allows us actually two things to restructure this whole setup, that we say, after Shanghai, we will have our staking product will only be in multiples of 32 ETH. That, first of all, frees up a lot of bank guarantee. And secondly, we're a lot closer to the protocol. So anything that may have happened with beginning of February in the US with the SEC and one of the Liquid Collective members should be a lot less of an issue for us because we're so close to the protocol. And at the same time, anybody who wants to have less than 32 ETH can go into LsETH. So it's really giving us this opportunity because we have an alternative as well.
That's great. And Ernest, you spoke about this briefly, but I also believe you guys ran like a pretty comprehensive study, right, on withdrawals and market perception around it. What were the findings of that?
Yeah, so I think it echoes a lot of what Freddie was saying. So we surveyed the institutional community, had over 1,000 responses, and some of the TLDR is that the protocol gets significantly de-risked, and so there's a majority of customers who expect to stake more on a net basis. Some customers will also unstake to change providers as the primary reason. But by and large, it's going to be an overwhelming addition to the staked ETH pool. Yeah.
Awesome. So I don't know how we're doing on time, but maybe we'll wrap up with just a little bit of what's next. So maybe Matt, you can talk a little bit about what's next on the roadmap and how the collective continues expanding.
Yeah, absolutely. So we've got to knock withdrawals out of the park. I'll say that first. That's going to be huge, not only for the end user, but a lot of partners in the ecosystem. I think it'll be a great push forward, and so we're going to be working on that. On the Alluvial side, we run a number of APIs to support our integrators with things like reporting status and being able to pay out service fees, these types of things. So I think we're going to continue to evolve that, listening to our customers and understanding how we give more transparency to build trust with the end user, because that's going to be super important. We're also working on validator performance standards. And so we're really excited about this piece because once we have these standards in place, we're going to make the validators' performance, their operations, transparent. And with that, end users will be able to see that. We'll also be able to expand the set over time, which is a huge piece towards our decentralization efforts. And then, beyond that, we're looking to expand to other chains as well. So we're going to start discovery work on the next chain soon.
That's great. What about you guys?
What's next? On the Coinbase Prime side, the continuing education of our clients and the market around us, helped by the team with material and intricate due diligence, particularly the regulated, both institutions and ETP providers. Continuing education is one piece, and then second piece is also as part of that education, but also the differentiators between LsETH, STETH, CBETH, RETH. Like, particularly for us at Coinbase, say, hey, we're a founding partner and offering LsETH. They're like, don't you guys run CDETH? Like, what are you guys doing? So on that piece, there are key differentiators, very, very clear differentiators, particularly for the institutions of which LsETH is targeted towards. So just continuing the education and the usability, as I said before, our financing desk and other types of usability of these LsETH.
I feel like we'll get an audience question on that, so I'll save it.
At first, it's pretty much the same. So as I said before, we'll start our sales and education campaign. And the biggest part will be to make our clients and prospective clients understand the difference between classic ETH staking and LsETH. And a lot of them will ask us then what's the difference to Lido. So we have to make that clear. And the second topic is we will be working on automating our processes related to LsETH more, so that we can scale accordingly.
Yeah, and on our side, it's really, as Matt was saying, this is kind of V1 is out there, protocol is live, but now it's about, continuing to ship, listening to feedback, improving different services. It's not just the protocols, there's also a number of auxiliary services that help integrators, help end users. So yeah, we're really excited to be working on all that stuff.
Awesome. Really exciting. And I think with the couple of minutes we have, I do want to make sure we open up to a couple of questions if you guys have any, so don't be shy.
Answered everything.
You did such a good job, yeah.
All around. Yep.
In the market neutral strategy that you mentioned, do your clients short the STETH or ETH?
Short ETH and long LsETH. But to short ETH, you need to borrow, and so you have that borrow cost to short. So you need to make sure that the borrow cost of your shorting ETH is lower than the reward rate you're getting from LsETH. So what drives the borrow cost is liquidity. Centralized or decentralized players who will offer that, they require liquidity to drive down and offer a low borrow cost.
Thanks. Don't be shy.
Alex. Question like for all parties.
Yeah.
How are you thinking about decentralized validator technology on the side and the side and elsewhere?
To make sure I understood, what are we? Yeah, okay, DVT. Yeah, so we are currently on the Kiln side active on testnets with both the kind of two major DVT solutions, Obol and SSV. We're getting more familiar with it. We're running validators, and then I think we're ready to sort of consider to add that to the roadmap when the time is right in terms of requirements and maturity of that. I do think it's a really important part of the future of Ethereum staking. Yeah.
Yeah, just to plus on that for sure. We run a pretty open architecture where we don't mandate any operational guidelines for our validators. We allow them to use their own best practices and develop them. But as things become kind of a standard within the industry, we want to usher that in. And so DVT is absolutely a part of that. Just to go way out and think about the likes of Coinbase, Figment, and Staked all running on the same logical validator and having that type of guarantee. I think that's absolutely a world where institutions that think about the tail risk scenarios of correlated slashing, this really mitigates that. And so I think that that also allows us to bring emerging operators into the set as well, right? In almost de-risking that as well. So I love to think about that future because I think that's an amazing place to be, not only for our end users, but everyone that participates in the ecosystem.
Same here. We're actively looking into Obol and SSV since a year about. We've been in early contacts. And for us, it's just a pure risk management thing. We run about 2.5% of the Ethereum network. So if we have anything that has some correlation and actually a large outage of our validator population, that can be really expensive. So try to avoid that.
We're the same. It's
Just a few multiples more.
DVT is
1.5% as well.
no. In terms of how we look at DVT, yeah, we don't disclose how much of the Ethereum network we're on. So huge fan of DVT technology, improving the redundancy and therefore potential slashing risk, and therefore lowering any slashing guarantees or slashing insurance that we either we provide or have to pass on to our clients. So really critical piece of technology, and I'm sure, I don't know whether Coinbase Ventures invested in any of the DVT. They probably
Both
did.
of them.
There you go.
Awesome. DVT, for those who are not familiar, distributed validator technology. It's effectively, aggregated signatures, allowing multiple participants to run a single validator with their predefined logic. So.
Yeah, we've seen A token and dual token models with some of the other liquid staking providers. Why did Liquid Collective choose a C token, and why is that potentially advantageous?
Yes.
This is a Matt question.
I can take that. So I've thought about it forever. Between maybe the A token model and the C token model, that's maybe easiest is the A token model accrues to the quantity of the token. Your rewards show up in the quantity, whereas the C token model, the rewards accrue to the value of the token. And so a number of considerations that we took into play, everything from ease of integration, but really came down to kind of the regulatory and potential keeping optionality for tax benefits open. Because if you think about it, you're not receiving more tokens into your balance. The value is simply increasing. And so there's no quantity that's being received there. So that was a huge component. I would say versus the dual token model, this is where you have a separate token for the principal as well as the rewards component. This came down to simplicity, really, and keeping it as simple as possible. This is a tough enough subject for institutional investors to really understand anyway, so keeping it as simple as possible was important to start with, and there are probably some regulatory and tax issues with that as well. And so we started with this. We thought it was the best token model for our end users.
And in countries like Switzerland, there's no capital gains tax if you're a private person. So again, having a value increase is basically tax-free if you're private, whereas having new tokens would be income. So.
Happy we have the Swiss perspective here. We're like, maybe I should be moving in.
I'm happy with it, so.
Awesome. Haslo.
Yeah, I mean, there's a mic going around, but I can ask it straightforward. Freddie, so you said it right. Someone had to ask the question. So, from Coinbase point of view, how do you see the differences perspective of between CBETH and LsETH from the clients and the regulators' perspective?
I'm not going to go into the regulators for many reasons. Coinbase is listed. Also, I'm not fully across the latest and greatest internally in the regulators' comparison of that. I can speak to the clients and the use cases. So the clients do ask the question, and that's part of our job is to educate the key differentiators between those products. Coinbase as a whole, whether it's custody, exchange, and again, not going anywhere near exchange and what we do and don't list, but Coinbase as a whole, our mission is to increase economic freedom in the world, which means we don't favour certain tokens or products just because they're Coinbase in-house. So that said, then falling back on the education piece, the key differentiators between CBETH. CBETH started as a purely Coinbase retail product of converting staked ETH, wrapping it in another token, which is a nuance, a little different, into CBETH. It's centralized, it's pooled, it's pure Coinbase, and Coinbase is the counterparty. That can be good and bad. As we said before, some people in crypto want to sue someone, so they see Coinbase a counterparty as a positive thing. So but it was in-house Coinbase. Now CBETH is starting to integrate across the crypto industry with different applications and across into institutional as well. CBETH, because of the wrapping and unwrapping functionality, it's actually quite difficult to integrate with other applications because they can't support that, or the KYC AML as well. So that's CBETH, and it costs 25% cut of rewards. I'm not going to voice my opinion there, but there are these types of key differentiators. A lot of institutions are using CBETH for different reasons. They don't care about the price or any of the other things. They just come in and out, trade it for their own reasons. It is quite liquid. Then LsETH as well. Key differentiators, look, Lido had first mover advantage, battle tested, it's very large, but the A token model, it's very crypto native. The underlying validators, I think there's about 30, of which some of them are pretty well known, but it's not as stringent as the underlying validator providers of Liquid Collective, of which we are one. And it's 10% cut of rewards, but still it is crypto native, not applicable across many applications as well, not tax efficient. A token model is rebasing, so a lot of institutions think or are advised that every time there's a rebase, it's a taxable event. These types of nuances. But again, in conclusion, Coinbase increasing economic freedom in the world. Just because CBETH is our in-house product, we don't favour it.
One of the really interesting things about Liquid Collective is the collective model. I'm interested in that. This is a good question for you. What are the roles of the collective, and how can companies get involved in joining the Liquid Collective?
Yeah, absolutely.
Can you repeat the question maybe, because you didn't have it?
Yep. So, Mark, thanks for the question. So, it was, who are the members of the Liquid Collective? What are the different roles, and how can you get involved? So, we've got a few integrators here on stage. The integrators are responsible for doing KYC on all the participants and then building on-ramps into the protocol. And so, we're gracious to have two live today. And so the other roles are node operators. They run the validators essentially in the background. And are able to, they basically are generating the rewards. And then we've got tech providers such as Kiln that help us build out onto other chains. And so if you are either a native chain builder, an integrator, or a node operator that's interested in joining the collective, certainly check with us after. We'd love to talk.
All right. Good stuff.
Thanks a lot.
Thanks.